right. Hi, everyone. I'm Tori. If you don't know me, I'm one of the cores at Team Hum. In terms of my career, I'm an associate advisor at an accounting and financial services firm called SC&H Group. So today I'm just going to go over some basic finance tips and budgeting tips. Just keep it pretty general for you guys and try not to get into too specifics, but hopefully find some benefit out of it. So here's my contact info. I'll share again at the end, but feel free to reach out to me at the end or contact me at any point whenever if you want to have a deeper conversation, feel free to reach out. All right. So just in general, in terms of the firm, so it is, like I said, accounting and consulting financial services firm. So we're mostly heavy in the tax team and auditing. And then I'm under the personal financial planning service line. Then we also have business performance management, consulting, risk management, and contract compliance. So it is a pretty, well, we guess classified as a medium-sized firm, so about 250 employees with 3 different offices. So I work in the Hunt Valley office, and then we have one in Columbia and Tyson's Corner as well. And the SC&H, if you're wondering, those are the last names of the 3 founders, which was created in 1991. So, and I work with the H, his name's Greg Horning. He's our service line leader. So that's pretty cool to get to work with him directly. So just in general, in terms of budgeting, how could it help you in your everyday life? So it gives you an action plan and a clear picture of where your money is going every month. So a lot of people will, check their bank statement and see, oh, wow, I only have, $300 left for the month. And don't really know where it's all going, or you scroll through your transactions, but you're like, wow, it all adds up so fast. So it'll really help you achieve the goals you're working towards. Whereas if you have debt and that's your short-term or long-term goal, it could help you with that, help you saving for retirement, or like I said, just trying to manage your monthly bills. So, once you do really start to see the whole picture of it, you'll really start to see that budgeting really is just simply spending your money intentionally, and it'll give you more freedom to spend in the end. Okay, so how we kind of work, our firm, or what we recommend usually is doing a $0 budget. So before the month starts, you're giving every dollar that you earn a name. So I wrote income minus expenses equals 0. So whatever your monthly income is and whatever your monthly expenses are, you'd add them up and you want that to equal 0. So just like I said, making sure you know where every dollar is going. And like I said, some months could be different than others. So, your car breaks down or something tragic happens, your, medical issues or whatever. So that's fine. And obviously that always happens everyday life. So you just want to plan for those occasions in advance if you can. Obviously, if not, if it's an emergency, then that's hard to do. But having some type of plan, knowing that it's coming in the future, is always helpful. And the most important categories you want to focus on first when just developing the budget is food, shelter, utilities, basic clothing, transportation, everyday life things. And then once your true necessities are taken care of, then you can start to fill in other categories such as, anything that really could be just restaurants, eating out, whatever. So in terms of resources, I know a lot of people, I have a lot of friends who are always like, I want a budget, I need to budget, but I don't know where to start it. So this called Every Dollar Budget app is super, super helpful. I've been using it since I graduated from college, and I find it Really helpful. It gives me a clear picture. It allows me to enter all my numbers in my monthly expenses, and I get to plan for every expense that I have for the month. So you'll categorize your expenses into certain groups, and you can get as specific as you want. I'll show you on the next slide just a sample budget plan on this app. But the first few months, like the first time I used it, it was tough because, you know, people just don't know what their monthly total grocery bill is. Like most people can't just come up with that number off the top of their head. So you'll probably find a lot of need of adjustments. So, you know, don't get discouraged if, you know, for some reason you go $300 over your budget for the first month. It just, you know, requires some adjustments for the next month, but you'll eventually get a hold of, you know, how much you're really spending in each category. So how it kind of works is every time you do buy something on your debit credit card, you would enter it in as a transaction. So this way you're going to know exactly what you're spending. There is this app like does allow for you to link your bank accounts, but I think it you have to have like a monthly subscription for it. So I don't do that. I just have the regular, it's free app. And I found that better just because, you know, you'll be more intentional about it. It'll make you, you know, if you spend $20 out on food, you're going to, you know, feel the pain, I guess, more of it instead of, you know, just letting it filter in through your bank account. So anyways, this is what snapshot of it looks like. So, oops. So you'll see here, just say for this is for the month of May. If you get paid bi-weekly or monthly, it doesn't matter. You would enter in each paycheck amount. So this example, I just did a random number, and then you can't see the whole entire page, but right here where it starts say giving, if you know you give to charity every month or something like that, I just put $50 to show that. So you'll see here on the right hand side, these are more of like the general categories that the app has. So like, you know, say you want to put $100 in your saving accounts every month, that could be there. If you're this person's $785 for rent or mortgage or whatever it would be, transportation, food, personal lifestyle. So we can get a lot more specific. My app, I specifically like to get really specific. So I'll do like fund money or, you know, my insurance and, you know, all of that stuff. So you can really be as detailed as you want into it. Okay, so these are just some general like financial tips that you can follow, and what our firm typically recommends in terms of like a debt payoff strategy. Most people, basically everyone has some form of debt. It's just the most common thing nowadays. So we call these baby steps to take in terms of just your whole wealth building journey. So step one is just save $1,000 for your starter emergency fund. So if anything, like I was saying before, just you didn't plan for it. Obviously, it was one-time emergency. You have a cover. And from there, then you want to pay off all debt. So that's, for most people, that takes the longest amount of time. You know, credit cards are the most common thing nowadays that can be super deadly and really dangerous for a lot of people if you're just constantly swiping it, because it comes off to a lot of people as money, but it feels really fake, and it feels better obviously than swiping a debit card. So that usually takes people typically the most amount of time. And then step three you want to do after all that is just saved 3 to 6 months of expenses in a fully funded emergency fund. So you would have all those expenses laid out. Max 6 months typically is what we recommend. And then from there, once that all done, then you can really start investing. So we usually recommend 15% of your household income. So if it's you and a spouse, 15% total. And then this doesn't apply for everyone, obviously, but if you do have children, from there, start saving for your children's college fund. And then the next biggest step is usually people's mortgage. So the mortgage doesn't typically follow in the step 2 debt. Mostly that debt is just going to be, whatever you have in car loan, credit cards, like I said before, student loans, all of that. And the mortgage is everyone's biggest debt payoff. Okay. So next slide. So just give a little bit further attention in terms of the debt payoff. So usually what we recommend is to do, rank out. This is just an example right here. So rank out your lowest to highest amount of debt in terms of, right here you'll see student loans 40, car loan 20, credit cards 10. So what we typically recommend is to attack the smallest amount. So in this case, it would be the 10 grand, just because there's been a lot of studies shown if you attack the lowest dollar amount debt that you have, you will pay it off faster. You'll start to feel the urge and the want to just keep attacking the debt. So it gives you one thing to focus on instead of, you'll still pay the minimums on all your other debt, but the extra money that you have left over after doing the budgeting will give you that extra leg room to just put in however much you can on that extra on that debt. And a lot of people typically want to just attack the loan with the highest interest rate, which is a good idea too. But like I was saying before, it's really all behavioral. So it's easier and faster when people can pay off the lowest debt amount first. In this case, the credit card. So that's typically what we like to recommend. Okay. And then just in terms of investing too, so your income, this goes back to the debt too. So your income is your most important wealth building tool. So like I said, if you have, 4 monthly minimum payments all going towards debt, you really can't have that leg room to build substantial wealth. So, once you are completely debt free and those minimum payments are done, all of that money can go towards investing. So that's your biggest strength is your income in that sense. And typically what we like to tell most of our clients is it's best to, if you're not fully debt free, it's best to postpone any investing you have right now. If you're investing in 401k or whatever you're investing in, to postpone it. And usually we say, it depends on the client's age and, a couple other factors, but max 2 years of like postponing and wouldn't really hurt your financial plan. So if you have a 30-year time horizon until you're looking towards retirement, then it's completely okay to postpone it 2 years. It's not going to hurt you in the long run. So that's typically the best idea, or else you're just going to be paying it until you're, 10. Most people take 10 years or so to pay off student loans. Just college is crazy expensive these days. So pre-tax investment accounts, most popular ones everyone's heard of, 401ks. So if your employer does have that, that's definitely the best thing to take advantage of, especially because a lot of employers offer a match. And then 403bs, those are for like nonprofits, hospitals, private institutions, and the functions the same way as a 401k. So those are also a good idea to take advantage of, and hopefully your employer has a match for that too. And then if you're not employed, a traditional IRA is always an awesome option as well. I'll talk a little bit about that next. Okay, so tax-free investments accounts. So what that means is with those contributions that you make into these accounts, um, they're going to be taxed first on the contribution, but then when you withdraw at retirement, it's all tax free. So that's a huge advantage to that. So the most popular ones are Roth 401ks and Roth IRAs. So like I was saying before, if your employer matches your contribution to 401k, 403b, any of that, you could easily reach that 15% goal I was talking about in the steps before about investing in retirement. That way, that's basically the best way to do it if you have that available. So investing up to the match in the specific plan, whatever you have. And then from there, if it's still not 15% of your income, then you start a Roth IRA or traditional IRA as well. So those limits, it changes every year, but this year it's 6,000 per person. And then for 401k contributions 2020, it's 19,500. So either, like I said before, between those two, you could hopefully reach your 15% towards retirement for that goal. Okay. So just generally too, how we usually work as a firm, we invest a lot in mutual funds. We don't pick single stocks. So the advantages we see of that, it allows you to invest in many companies at once, from the largest and most stable, such as Microsoft or any of the big companies, Facebook, all of those, to the new and fast growing ones. So spreading your investments among a majority of companies and wide variety of different sectors, that helps you avoid the risks that comes with just investing in a single stock. And then with single stock investing, your investment depends on the performance of individual companies. So that's kind of what we see as the downturn of it, and the pros of why we see mutual funds as more beneficial than the single stock investing. And obviously, it's a huge risk to take with your money that you are counting on in the future. If for some reason that company goes bankrupt and all of your retirement hard-earned income is in that one single stock, then it kind of puts you in a tough situation going forward towards retirement. Okay, and just what it's like to work with a financial advisor. So that's what I work for, group about like 5 advisors at my firm. So, constantly attending client meetings and doing the pre-work and the after work and all of that. Just really just having conversation with the clients, figuring out where they are in their wealth building journey and all of that. So it's their job, the financial advisor, to stay on top of investing news and trends. So as you see now, in March, when the stock market completely fell, everyone panicked. Just all the investors would take their money out of the stock market and freaked out. And that's one thing that the advisors really work on preventing. They don't want the clients to sell when stock plummets. So we take a lot of the stress out of clients, and just kind of get them on a clear path to how investing really should work for them. So they'll keep you on track, like I said here, towards your retirement goals. And they'll provide you, good insight and direction based on all their years of experience. But in the end, they know that you're the decision maker. We're just offering the advice. And you always want to just, not if you're looking for one now, but down the line, say, with your spouse or whenever you do think you would want to look into one, you always want one who takes time to answer your questions, gives you all the information that you need in order to make like I said, your own choice, because in the end, it's not up to them. And in general, with all financial advisors, obviously there's some type of fee. So there's no really avoidable part of that, unfortunately, but there are 2 ways that they are paid. So how we work, we're under this right here, a fee-based pro. So we are compensated based on a percentage of our assets under management. And, depending on the market, it's going to rise and fall depending on whatever your portfolio value is. So that's how that one works. And then a commission-based pro, they're paid up front based on a percentage of the money you invest. And like I said, those percentages could vary too from one investment to another. And just a general tip, never invest in anything until you fully understand how it works. So that kind of back to what I was saying with financial advisors, you always want to, be upfront with them and ask any questions. If you have any uncertainties, you want to make sure you know what you're getting into before you get into it. So that's about it. Here's just at the end my contact info, my cell, and that's my work email. If you want to contact me at any point or would like to have a further in-depth conversation about your specific financial journey, I'd be happy to help. So just let me know, and thanks for listening. Hope you guys all have a good day.